Welcome, everyone. For this month's crypto market briefing, we're sharing the views of some of the leading names in the crypto investment world. They explain why this pullback is not the start of a bear market and why the 4-year cycle is no more, as we enter a new post-ETF, pro-US government and institutional era for digital assets. We all agree that the outlook for Q4 and 2026 is positive. Let's start with Matt Hoogan, CIO of Bitwise Asset Management, who recently said the crypto market is close to a bottom.
Crypto retail is in max desperation. We've seen leverage blowouts. We've seen issues with vaults. We've seen issues with yield protocols. And the market for sort of crypto native retail is just more depressed than I've ever seen it. I think that market is close to a bottom. It's hard to find a crypto native investor who still has much enthusiasm for the market. I think the market is shifting into an institutionally driven market. And interestingly, that market is still bullish. When I go out and speak to institutions or financial advisors, they're still excited to allocate to an asset class that, if you pan back and look over the course of a year, is still delivering very strong returns. So my view of the market is we have to get through this retail flush out. We have to hit bottom from a sentiment perspective. I think we're very close to that. And then I'm optimistic that we rally into the end of the year and into 2026 as the institutional investors who are more maybe even keeled about what's going on at a fundamental level in crypto start to drive the market forward. So I'm optimistic, but we do have to finish this washout of retail sentiment. And again, I think we're closer to the end of that.
Shifting to the macro perspective, Raoul Pal, CEO of Real Vision, believes this cycle extends into 2026. He argues that crypto no longer follows the traditional 4-year rhythm, but instead tracks a broader macro liquidity cycle. Based on dollar trends, global debt rollover, and expected liquidity expansion, his framework points to a peak in Q1 to Q2 of 2026, with crypto acting as the high beta expression of rising liquidity.
The question is what drives the 4-year cycle? It was for a long while, people in crypto thought it was to do with the Bitcoin halving that happens every 4 years. And therefore there's a supply shock, but each year now the supply shock is less each time. So it can't be the predominant driver. But then when you look at all assets, they're all driven by a 4-year cycle. And that was the cycle of the rolling or refinancing of the debts. So then if the structure of the debts is most important, what could have changed? Well, back in 2021 and 22, interest rates fell to 0 again. So they extended the duration out by a year and got it to about 5 years. So if debt maturity and the refinancing of it is the dominant factor, then if they've moved out from 4 years to 5 years, the cycle should elongate. And that seems to be what is playing out by all the forward-looking indicators that we use. It says that the cycle doesn't finish until maybe this time next year. So that's a brave call, but it's a probabilistic analysis. And when people say, yeah, but the famous words of this time is different, I'm saying it's not different. It's just based on the debt. It always was. So if it's based on the debt, nothing's changed. The debt maturity has been extended to 5 years. End of story.
Finally, Tom Lee, head of research at Fundstrat, says the old crypto cycle is dead. He emphasizes that macro liquidity and institutional flows now drive market structure. These inflows develop over years, creating a longer and smoother uptrend that, in his view, supports a bullish extension into 2026.
But as you know, when something is so strongly held, it's very unlikely to be true. So either Bitcoin's already peaked or we have a longer cycle. I'm more in the camp that it's a longer cycle. In 2025, we're tokenizing more than just the dollar. The stablecoin is the breakout product, which is a tokenized dollar. But as you know, Larry Fink, Robinhood, they want to tokenize everything on the blockchain, and they're going to build it on a neutral public chain, which is right now, 70% of that is happening on Ethereum. So Ethereum is experiencing that same 1971 moment where Wall Street's rebuilding everything onto a blockchain, which we think it'll be Ethereum. Ethereum could recover its Bitcoin Ethereum ratios, 2021 highs. that would put Ethereum at around 21,000 per token. So it's I think an undervalued asset.
Across these perspectives, the message is clear. The traditional 4-year crypto cycle is expected to stretch into a longer cycle as market reactions to Bitcoin halvings slow and institutional involvement grows. Higher global liquidity, partly driven by the need to refinance expanding US debt, also delays market tops and lengthens expansion phases. Together, these forces create a more gradual, extended cycle. Therefore, the outlook into 2026 remains constructively positive. For more info, please contact us at info@blockassetmanagement.com. Thank you.